the consumer, which is 2/3 of our economy, is not happy and is actually depressed because their wage gains, income gains, are not keeping up with inflation. Their real income is dropping. We see auto sales coming back down, and everyone says, oh, that's supply chain. We see furniture stores, big disappointment. Restoration hardware is a good example. One retail industry after another is saying, whoa, something's happening here.
Welcome back, rich followers. In this video, famed investor Cathie Woods discusses her views on why Bitcoin will be worth $1 million in the near future and her thoughts on innovation. We hope this video inspires you to get started on your dream. So please watch until the end. And if you are new here, consider subscribing so that you won't miss other educational videos like this. Let's get started. Cathie makes a prediction that Bitcoin will be worth $1 million per coin. Listen as she explains why.
We see that scaling to $1 million by 2030 or more for all kinds of reasons, not just store of value, not just the cross-border payments, but remittances, not just that, but institutional investors, insurance policies that high net worth individuals take out so that their wealth won't be confiscated like we're seeing more and more often these days. And, a substitute for money in emerging markets where they can't trust their monetary regimes or their fiscal regimes. So we see an incredible number of use cases, and we think Bitcoin will be leading the charge in many.
Cathie Woods explains her views on Bitcoin and her opinion on why institutions are not adopting it.
We were the first public asset manager to gain exposure to Bitcoin in 2015 when it was $250, and we think it's just begun. But I don't think most institutional investors are positioned the way they ultimately will be. A lot of retail has really led the charge here. They, like with our other funds, the retail investor, the individual investor, those people with one foot in the new world, they get what we do. They get Bitcoin. So I think institutions are coming along slowly.
Cathie then explains a bit about her investment philosophy for retail investors, and also why institutional investors are beginning to garner interest in her investment funds.
So most of our investor base has been retail, but we have been cultivating institutional relationships for the past 3 to 5 years. We do have institutional investors, but we have 2 conversations. For the retail investor who's been with us, who really does believe that we're onto something, that innovation is going to disrupt every sector out there, and they want to be on the right side of change, we have educated them. We have a 5-year investment time horizon. Everything we do, keep your eye on the prize, average down if you can, and usually that sort of disciplined behavior will work out over time. We often say time, not timing. In fact, one of our clients in Japan, Mizuho Fuke-san, that's his words. Those are his words. Time, not timing. And we have a chart now. If you look, if you held stocks instead of trading around them over time, you would have done much better than trying to time. So that's the retail base. So they're holders and they're averaging in. Institutions, in 2020, we had incredible performance. Innovation solves problems. COVID brought with it a lot of problems. And I think a lot of institutions looked at us, what is this in terms of where does it fit into my matrix? And so we don't fit neatly into a matrix that any of these ratings agencies have or so forth. So I think we're being put into the alternative bucket. We're the closest to a venture capital fund in the public equity markets. And now they're looking carefully at us because of our research. The screen for our portfolios is not any benchmark. In fact, until recently, I didn't know what was in benchmarks. And I didn't know that of the 28% in technology in the S&P 500, we don't own any of them. We're very different. We're not backwards looking, we're forwards looking. And I think institutions are beginning to see the bifurcation between valuations in the private markets when it comes to innovation, which is where they are, and innovation in the public markets, and they're saying there's an arbitrage opportunity. So we're getting a lot more interest from institutions.
Cathie then explains about her recent underperformance and how investors might be viewing that.
The investor who has been attracted to our strategies is a younger investor. Also, it's across the spectrum, but the younger investors and the older investors who take us seriously about our 5-year investment time horizon, they're fine, because if you look at the past 5 years, we have outperformed NASDAQ, S&P, while I don't know what the number is, 75 to 80% of truly active managers have not. So we have that as a calling card, and we have a 5-year investment time horizon. We also give away our research. This is why we're investing in this space. And now we're playing more of a ground game, I would say. We're going to be publishing more of our models. So Tesla, we will put that update on GitHub next Monday, and we'll be tweeting, and our analysts will be doing videos so that our investors can understand the depth of knowledge that our analysts have beyond the depth of knowledge, I think, of any other analyst in these technologies. Reason for that is we have organized our research teams by technology. There are 5 major platforms involving 14 technologies that are cutting across sectors. So they're technology specialists and they are sector generalists. We think that's the right way to think about innovation. And I think that our investor base is reading our research, seeing the merit that it has.
Please hit the like button if you are getting value from this video. We appreciate your views and want to continue providing you videos to increase your financial IQ.
And they also understand how our innovation platforms are going to disrupt the investments in their base portfolios, their core portfolios. So they're using us at least for a hedge against those value traps.
Cathie then issues warning to companies who did not invest enough in innovation and how they will be affected.
Many people hold Bitcoin as an inflation hedge. I've just given you a deflationary story. If we're right and deflation does happen, all of those companies who did not invest enough in innovation but leveraged up to deliver short-term profits, they manufactured earnings with lower share counts and they paid dividends, they're going to be in harm's way. In order to service their debt, they'll have to lower prices. So that's a part of the deflationary undertow we see out there as well.
Cathie then discusses how the changes in interest rates will affect Bitcoin prices and the industry.
Many people think monetary policies around the world have been unhinged, especially since 08-09. And they're seeing extreme increases in the monetary base, various monetary bases around the world. So Bitcoin is a hedge against inflation. Now, that will turn into inflation if the reserves on central bank balance sheets, which are the kindling for inflation, if they're lit. And that means if bank loans go crazy to the upside. We're seeing a share shift when it comes to loans into DeFi. I think the banks have a big problem. They're losing talent to crypto, so they're having to raise wages to attract talent. And they're losing business to DeFi, lending and saving. A lot of it is taking place in DeFi right now.
Cathie then explains why her ARK ETFs may be underperforming and gives a message to investors who are worried.
I'll separate this into retail and institutional, although we think the lines are blurring here. It's very interesting that retail has been the early adopter of our strategies. And I think it's because individual investors see the ground shifting underneath. So underperformance. Anyone who's been with us for the past 5 years has outperformed the S&P, NASDAQ, MSCI World, and we have always told our investors, 5-year investment time horizon, where the closest you'll find to a venture capital fund in the public equity markets. There is volatility, but truth will win out. So keep your eye on the prize. And they know this is the way the world is going. So we have had incredible asset retention, $17 billion in net inflows last year. We're inflowing this year as well. And I think that's surprised many people in the financial services industry. On the institutional side, we do have institutional investors. We don't fit neatly into any matrix. So I think we're in the alternatives bucket. So the closest again to a venture capital fund. And they have been kicking the tires for the past 3 to 5 years. And now we're beginning to get flows from institutions. So they looked at 2020 and said, okay, this has gone too far. They look at what's happened, down 60% at one point since our peak. Again, we were up 360% during COVID, down 60%. They're saying, okay, compared to the valuations in the private markets for innovation, which have hardly budged at all, this is innovation in bargain basement territory. So we're getting institutional interest.
If you found value in this video, we would like to give you another video for you to enjoy next. We would highly appreciate it if you could like this video and share it with your friends on social media. Don't forget to subscribe if you are new here, so you won't miss another one of our videos. The more you learn, the more you earn.